Hi guys, so this is a follow-up to my balance sheet video. I provided you with some information on how to understand a balance sheet, and I picked Tesco PLC as the company to look at. So I've gone to Tesco again. If you want information on how to get Tesco's accounts to follow what I'm saying here for yourselves, you can go to my balance sheet video. I'll link it in the description below, and I've got instructions there on how to get all of this from Companies House. It's all for free. You can download any company set of financial statements on there in the UK. So I just want to show you, just going to run through the profit and loss statement. Some of it is going to be obvious to you. I'll just run through here because there are some funny adjustments and things which may be unfamiliar to you. So it looks like they had some funny things going on in the year, just to warn you as well. So sometimes they have these one-off things going on. So you can see they've got all these columns where they're saying it was this before we adjusted it, here's the adjustment, and now there's the total. They've been doing something odd in here in this particular year, I think. So you just got revenue from goods and services there, so that's just people going into Tesco and buying things. Insurance revenue, they must have been selling insurance contracts, so I presume that is, Tesco pet insurance, that kind of thing. Cost of sales will just be everything, the cost of all the items on their shelves, and also the cost of direct employees, so the people that are working on the checkouts, things like that. All of their wages will be going through there. Insurance services expenses, so same thing again, the wages of the people that deal with Tesco pet insurance, Tesco car insurance, all of the expenses associated with that revenue stream will be going through there. Reinsurance contracts, I'm not sure what that is. You probably don't need to worry about it too much for the purposes of your fundamental analysis. So then they've got their gross profit or loss. Then they've got admin expenses. So within your admin expenses, you're going to get, so basically the top bit here, before you get to admin expenses, these are all the costs and revenues associated with running the operation. You can see here, continuing operations, that's the heading for that section. And then you get to your gross profit. So gross profit is normally, the profit you've made from running the business, doing the business activities. Then you've got admin expenses. So within your admin expenses, you're going to have things like director's remuneration, the admin upkeep of running the company, paying the tax advisors, paying the auditors, subscriptions for people who work there, all of the admin staff, people who work in the accounting team, all of their wages and salaries are going to be going through that line. So share of post-tax profit or loss in joint ventures and associates. So this will be their share of profits where they have an interest in another business, in another company, but their interest is not the controlling shareholding. So they've got a bit of a business interest in another venture, and they're required to recognise the profit on their statement in that way. So finance income could be all sorts of things in there. Could be anything as simple as bank interest on their bank deposits, or to something more complex, like there are complex types of adjustments that go on which result in finance income. Trying to think of an example. So if I give you the opposite example to start with, it might be easier to understand. So within finance costs, you're going to have lease liability interest, for example, but let's say they're renting out one of their stores to somebody else. In that scenario, they would be the lessor, and they would be recognising some finance income in there, I think, to do with that lease. So there can be all sorts of funny things going through finance income and also finance costs. Finance costs, generally they're going to be things like bank fees, but you are going to have funny accounting adjustments in there as well. If you've got any loans, they're going to be, the interest is going to be going through that finance costs line every month. So then you've got profit or loss from continuing operations. Then you've got the tax that they're paying. So that it won't actually strictly be tax that they're paying. They also do something which is referred to as deferred tax adjustments. So that's where there's going to be a tax liability or an asset due to or from the taxman at a later date, and it's just recognising that there's a slight timing difference between what the taxman says he's going to get or pay Tesco and get from or pay to Tesco versus what we've got in the accounts. So there could be an adjustment in there that aligns the accounts to what the taxman is expecting. Another profit subtotal. So you've got discontinued operations here, and this might be why you've got those funny adjustments and all of the funny columns, because discontinued operations is not something that you see in a set of financial statements every year generally. This is like a really unique type of adjustment. So it may be that they closed one of their stores in a particular area, and they've recognised they've had to impair some of the assets and things, close everything down, recognise losses, or it could be, normally it's a lot of the time you're going to see costs there rather than revenues. And then you've got the profit or loss for the year. So the profit or loss is then split. You can see this 1989 equals 1989 here. It's the same number, so it's just showing you how much of it is attributable to the parent, the owners of the parent, and then you've got no non-controlling interests there. So this is to do with the split of the shareholdings. So how can I explain this? I think if you own if you own shares, sorry, excuse me, in Tesco, I think your shareholding, the profit that will be attributable to your shares will go through that line each year. But because you're not the controller of Tesco, it's gone in the non-controlling interests bucket, if that makes sense. And then whoever owns Tesco, it looks like they've got a parent company here, so they're part of a big group where there's another big company that owns Tesco. So that's the share that they get based on their shareholding. That's the share of the profit that they get based on their shareholding. So in these large companies, it's quite helpful that they normally give you earnings per share and things like that. So this is going to be really helpful when we are looking at balance sheet ratios, which is going to be the subject of another video, so you can watch out for that. So this is the group statement of comprehensive income. So what's the difference then? This one here, let me see. Sorry, let me just have a look. Group income statement. Just trying to find, there should be a parent only income statement and also a group one. So I'm just having a look for that. Group balance sheet, group changes in equity, cash flow. Can't find it. I'm just going to take you through these items anyway. I think the parent only. Do you know what it is? In a set of financial statements where there's a parent company and they've also got subsidiaries, they're required to show the balance sheet for both the parent company and the group. Parent company only and group. I've explained this in my balance sheet video. But when it comes to the profit statement, they're just going to show you a group profit statement. So that's why I'm not seeing it. It's only the balance sheet that they'll show both for. So this is the group's profit statement, meaning whatever they've got in these lines, it also reflects the income and costs and the profit statement of their subsidiaries. It's all added together like one big company. So we went through this one. Statement of comprehensive income. So this can include odd items that you won't see in the normal profit statement. So let's just go through and I'll try and explain what some of them are. Change in fair value of financial assets through other comprehensive income. So this can be things like hedging contracts, forward exchange contracts, forward contracts for FX, for exchanging, euros into pounds at a later date for a particular rate. What they do is they assess the value of those contracts at the reporting date, 22nd February, and they decide whether or not those contracts have gone up or down in value based on the spot rate of exchange, for example, versus what it was when the contract was entered into. So the movement on that item will go through this type of place in the profit statement. They'll increase or decrease the asset on the balance sheet, and I mentioned that in my balance sheet video. And then the other side of it, because you've got debit and credit in the accounts, will go through the profit statement as an income or a cost. Remeasurements of defined benefit pension schemes. So defined benefit pension schemes are the wonderful pension schemes that hardly anyone has anymore, where they pay you a final salary pension, those kind of ones. So there are very technical, specific rules which are in place to tell the company how to account for movements in the value of their defined benefit pension schemes. And all you need to know is whatever happens to the asset or liability on the balance sheet, the other side of it goes through here. So if the asset's gone up, you're probably going to get some income there. If the asset's gone, if the liability is there and it's gone up, you're going to get a cost there. So I hope that makes sense. So you can see here net fair value gains or losses on inventory, cash flow hedges. So this is again where they're doing hedges, trying to cover a risk for things. So it could be, the times that they're covering risk, you've got to think about what's at risk for Tesco. It's going to be interest rates. It's going to be exchange rates. They don't like risks generally, uncontrolled risks. So they'll try and put contracts in place to control risk, basically. So they're doing some sort of cash flow hedge to cover risk on their inventory items. Tax on items that will not be reclassified. I'm not sure what that is. I wouldn't worry about it too much. It's just going to be the tax on some of these odd items, I think. Change in fair value of assets at fair value through other comprehensive income. So this could be the same thing again. Could be forward contracts. Could be there are a lot of different things that can go through there. So trying to think. There's situations where they're revaluing assets. Like I forget where the investment property reserve ends up going. I think it's through other comprehensive income. So if they've got an investment property, I think it goes through this sort of area as well. When they're putting the value of it up on the balance sheet, they're going to have to recognise the other side in the P&L, in the profit statement. So it's going in these sorts of places, the movement. Currency translation differences. So retranslation of net assets of overseas subsidiaries, joint ventures and associates. So what that is when they've got subsidiaries in other countries that are trading in different currencies, bearing in mind what I told you, where they add everything together like it's one big company. They're going to get their subsidiaries accounts and add them in with their own. Let's say the revenue of the subsidiary is 5 million and their own revenue is 10. They're going to present these financial statements like they've got 15 million. Okay, so at the point that they're retranslating that revenue from the subsidiary into a common currency, into the currency of the parent, so in this case it would be British pounds, they are going to be exposed to some exchange rate movement from one year to the next. So there's a reserve on the balance sheet, and also some of it goes through the profit statement where they are recognising the movement of the exchange of those foreign currency subsidiaries. So that's what that is there. Impact of net investment hedges, more hedges, net fair value gains and losses, finance income from insurance contracts issued. So these are just finance incomes. So nothing else major there. You've got these continuing operations and discontinued operations. There's a specific requirement that asks them to disclose discontinued operations as a separate line on their P&L, but you're not going to see that every year on any. It's quite unusual to see that sort of item in a set of accounts. So I hope you found this helpful. I think I went through this balance sheet previously. Let me know if you've got any questions. If there's anything that you're finding really odd, or I'm scooting over things that you don't understand, just let me know in the comments and I'll do another video, because I come from an accounting background. I used to work in audit. This was like the bread and butter of what I was doing in my big corporate job, and which I hated. Just as an FYI, I learned a lot of things from it. I've got a lot of knowledge in me, which is enabling me to share my knowledge on YouTube. But the pressure from the corporate life was something that I didn't enjoy. But I'm happy to share the knowledge and help people who want to invest in the stock market understand what they're looking at. So, as I say, if there's something that I have scooted over, which I haven't been clear about, or I've just taken it for granted that you know what I'm talking about, then let me know in the comments and I'll do another video. So, hope you found this helpful, and I'll talk to you later. Bye.